Hi, this is Ron Janish. Just got back from beautiful downtown Istanbul where we had a really nice seminar, and this was a little treat that I threw in. This was a visit to Sultana's, which claimed to have the best belly dancer in town. I don't know if she was the best, but wow. Anyway, this video is not about Sultana's and not about all the things we did at the seminar, but it's specifically about one or two of the real rules of Alan Andrews. And the reason I call it the real rules of Alan Andrews is because, quite frankly, there's just a lot of stuff on the web that isn't about the real rules. And the real rules are pretty much what he communicated in his newsletter and what he communicated privately to us in seminars and privately to me at the kitchen table in many cases. So here's Alan Andrews, and if you want to take the course, you just go to andrewscourse.com, one word, and click on products, and there you can see a description of it, and you just click on here and you get it, and that's the way it is. So anyway, we're going to talk about one of the real rules, and this is useful especially for people who have taken the seminar, because what we're going to do is we're going to show you effectively proof that we have on the effectiveness of his rules and of his techniques. So here's what happened. Prior to my going to Istanbul and all that kind of stuff, in at the beginning of August, I did a, let's see if I can find this. Ta-da, ta-da. No, that's not it. Here it is. I did a test, and what I did was a test of a simple, straightforward mechanical system using the Andrews rules. And before I did the test, I did one of these, historical studies, and in the historical studies I found that for every one losing trade, there was like 4 or 5 winning trades, which was a pretty good number. Now the trick is, when you do that kind of stuff, the trick is to be able to do that in the future, in real time, where you don't have the benefit of 20/20 hindsight, right? So what I did was I put orders into Investopedia, nice third party thing that I tell people to play with and use, and to make it really, really simple, I put in an order for 200, usually 200 shares each time. And this is not a really valid study, because if you're trading it in real time, you're probably better off having your portfolio at not 200 shares, but let's say if you're using $100,000 portfolio, to have 5 or 10% of your trades, let each of your trades be 5 or 10% of your total portfolio. So in other words, let's say you're willing to do margin, then you might use 10%, and so you might have a total of 20 trades. But rather than do that, what I did was I just did the 200, and I had a whole bunch of buying power left over, and yeah, it was profitable. It was up. We started with 250,000, and when I came back from the trip, this is the number today, and I've been back now for a few days, and it says the annualized return is 74%. Really not accurate. It would probably be different, probably a lot more, because of the haphazard way we put on the trades. So as you can see here, a lot of the trades were nicely profitable when you get 20-30% and all that kind of stuff on a trade. This one here, you had 64%. So anyway, so much for all that kind of stuff. So what we found was that we wanted to test out in the future, in real time, would we be able to achieve the same win-loss ratio that we had on the historical studies? And the answer was yes. We were able to achieve that. So it did have some losing trades, and we did keep that nice high win-loss ratio. And what I did was let's just call it cheating a little bit. What I did in order to do this was I used a simple, uh, a very simple algorithm that you can pop into pretty much any computer program. You don't have to be a programmer at all, um, and any kind of charting program will let you do this. And so what it would do is it would pick out the the potential trades for the next day for me, and that was really nice and easy. And then I discovered some really cool stuff after I came back. And here's what I discovered. And this thing, by the way, did longs and shorts and all that kind of stuff, and did reasonably well. As you can see, it was up like 7%. And this is, what's important here is how much of a time period are we talking about? We're talking about a month and a half. Okay, and we're talking about and so you want to ask, well, gee, how did that do versus the S&P itself, for example? And the S&P was up about half that amount. So this is pretty decent. And one of the important things when doing a historical study is you really want to have over 30 trades, and as you can see, we had far more than 30 trades. We probably had over 50 altogether, maybe 60 or so. All right, so we did that. Now on to the real rules of Alan Andrews. So what we found was that, let's move it down to here. Okay. Now if you look on, where is that? Here we go. Okay, if you look on here, let's just take the first couple of trades that were on here. These were done back, the reason they're the first couple of trades is that these were done at the beginning of August. Okay, so right there at the beginning of August, that's when these were done. And let's take a look. PDCE, let's take a look at that one. There we go. Okay, now what we found was very simply that Andrews had a rule, and we talk about this rule in the last set of videos that we send you. And if you course members remember, in the video set, there's 3 or 4 sets of videos that I send you, and these are not publicly available, of course. These are available only to those who have taken the course. And what I do is I suggest that Andrews said there was a certain line that he would draw in order to determine if the trend had changed. And so we draw this line here, and notice that, okay, let's take a look at what value the buy was. The buy here was at 53.44. Let's take a look. 53.44, which would have been around here somewhere. Okay, so the buy was somewhere around here. 53.44, there we go. Okay, the buy was somewhere around here. Okay, and notice that prices stayed above his line. Okay, and so we looked at that and said, yeah, that's pretty cool. And then we said, here's another one where they stayed above his line. Okay, in terms of the correction. And let's take a look at where this thing got in. It got in at 1601. Where the heck is 1601? If I press the right button, here we go. 1601. That would have been over here somewhere. Okay, and then prices shot up thereafter. Okay, so, and if you notice on this one here, prices went past the line, and even and this thing doesn't work perfectly. So in theory, Andrews concepts might have avoided this one here. Okay, simple as that. Okay, let's take a look at another one. This one just shot like crazy. And this one here, it was nowhere near any kind of a line. Actually, you couldn't have drawn one of those lines here. So let's find a better one. See, because the point I want to make is that when prices are really far from that line, that chances are very high, you're going to get a 20% plus move inside the next 2 months. That's pretty good. That's what we found in our historical studies. So let's take a look. Where's one that just did spectacular? Oh, wait a minute. Here we have ASTOIL. Okay, here we go. And so here was the original line. And then there's if you remember in the studies that I did in the final set of videos, I talked about two lines and how I was kind of confused about. Andrew said, well, it's this line, and then another time he said it's this line, which is a lot closer. So here's the further out line that we used in the other things, and here's a very close one. Now you can ignore the very close one if you just look at the one line, okay, that the main one Andrew's talked about, that says, hey, if prices don't go past here, probability is really good. It's going to continue. And as you notice in the correction, if we get rid of this thing here, it went nowhere near this line. It was miles away when it went down and did the correction. And let's see where I wound up getting in. Let's see. Here's OIL, got in at 25.54. That's strange. Looks like I got in too late. Okay. Yeah, I got in real late on this guy. Okay, so let's take a look at another one. CEO. Find a better one. AMCC. Okay, this one's easy because your line is going to be somewhere down here, and prices are nowhere near this line when they made the correction. And so let's take a look on as to where it went long. AMCC. Let's take a look. There we go. Went long at 11.34. Let's take a look. 11.34. Okay, somewhere around here. Somewhere around this value here. Okay, so the idea is to the idea that I had was simply to out of all these 50 some odd trades, is there a way of easily finding a way to determine which are going to be not only the fast movers or faster movers than the rest on average, but also which ones are likely to have less losers. I mean, you know, when you have a 4-to-1 or 5-to-1 ratio of winners to losers, that's pretty darn good. Okay, you have a more robust system because you have a lot more trades. But this particular approach gives you only, well, 1 or 2 trades a week, okay, and which is a heck of a lot less, and it typically you're out of the trade within a month is the approach that I use. So this was my test of Andrews, and so the real rule of Andrews here was the line we talked about in one of the last videos, which simply said when you have prices, and this one here, your line was, oh God, it was probably down here someplace, and so when they shot up here, you know, we were looking for a really substantial move. So the rule is very simply that when you have when you use the Andrews line for determining how far the correction should not go. In other words, if it goes past this line, watch out, the correction is probably a move that's going the other way. Okay, and that's another, I'll go over that in a second to show how incredibly useful that is. So if you can do that, so if you can, first it helps you find which ones are likely to keep on going, okay, after a correction. And then number 2 is if prices go nowhere near that line, they stay really, really far away from that line, then the probability is really good. You're going to have a fast mover and and fast substantial mover. Now, how this is also useful is that this was a fast substantial mover. See, when prices come down here, and let's say you get a buy, because prices did not go anywhere near the line we were talking about, which had come in down here somewhere and was far away, you would not suspect that this is the start of a downtrend. Okay, that this, when you have this much data here, it is not the start of a downtrend. And the same, let's say you come over here, okay, you're over here and you have the buy. You would be able to easily look at this and say, well, gee, prices did not go past that line, so it is not the start of a downtrend. And that's the really cool thing about this, is that you can use it in order to determine which ones are, when you have a reversal and you're looking, your price reversal, and you're looking for an entry point, you need to know which ones are part of a downtrend, so versus which ones are most likely to keep on going. Right? That's really important. Okay, so you can use that one simple rule, that one simple line, to say, okay, if prices go past this line, then the probability is really good that a trend the other way has started. Let's see if we can find these guys again. Where are they? There we go. Okay, so they didn't go past this line here, for example. So this tells you that probability is that as this trend continues, it will continue to the upside, rather than, hey, it's down we go time. Okay, so that's something that's really important. And this is part of the real Andrews rules. Okay, so now getting back to the original very important topic. There we go. Okay, that's the belly dancer sideways. Next time you're in Istanbul, look for this restaurant here. This is the place to have lunch. It's just a block or so away from the Naval Museum, which is right along the water. This guy has lines that are like 6 and 7 people deep, and they're not tourists. They sell this stuff like it's going crazy, and he makes the absolute best pocket sandwiches around, and he puts some vegetables in there, and they're really delicious. So this guy is incredibly well known, and this is probably one of the best restaurants I found in Istanbul, believe it or not. That and I ate at the Hilton. So I don't recommend the food at Sultana's. Anyway, but Belly Dancer was good. So I thank you for your time. If you've not taken the Andrews course, remember, this is not just some simplistic thing where, oh, it goes down to this thing you buy, goes up to this thing you sell. It's a bit more involved in that, and there's several different concepts and rules that enable you to have a leg up on other people in the market and have a deeper and richer understanding of what the market is doing. So you can come to Istanbul and join us for a really nice lunch here. Okay. Anyway, so much for that. And I do thank you for your time. And when you get a chance, go to andrewscourse.com. And thanks for watching this little video on the study that we just did. And we'll see you next time.